Welcome back to Boss Economics World, folks, where we dismantle the baffling decisions made by our so-called economic leaders and dive deep into the absolutely bewildering mess they keep landing us in. Today's episode is a juicy one. We're talking about interest rates, inflation, and the economic gymnastics that keep the Fed dancing a precarious tango with a recession they helped orchestrate in the first place. Buckle up, because by the time we're done, you'll be scratching your head and wondering if anyone in charge actually has a clue about what's going on. Now, let's get straight into it. Our man of the hour is Philip Jefferson, Vice Chair of the Federal Reserve, who just delivered a speech that could only be described as the equivalent of watching paint dry, while trying to convince us that inflation's cooling down, our economy's still resilient, and therefore, it's time for the Fed to sit back and enjoy the view. Yeah, I'm sure that'll work out just fine. But here's the kicker. After cutting rates in the latter part of 2024, Jefferson and the rest of the Fed apparatchiks have now decided to hold the benchmark rate steady, between 4.25% and 4.5%, because apparently, it's better to wait and see what happens. Let's look at why that logic is about as reassuring as finding out your Uber driver has just unlocked the app for the very first time. So, what on earth is really happening behind this policy stance, and why are they so trigger-shy? Jefferson speaks like someone trying to sell you the idea that the worst is behind us, stating that inflation, though on a bumpy path, is headed toward a much more palatable 2% target. He's carefully choosing his words to avoid any absolute guarantees because we all know after the last couple of years, nothing in this economy is guaranteed, unless you're a major hedge fund, in which case, sure, let's continue bailing them out on time. But let's unpack that a little. The Fed's preferred measure of underlying inflation may have looked muted in December 2024, but have they forgotten about the rest of the year? Inflation was still well above that handy little 2% target throughout the bulk of it, peaking near 3.8% in the second quarter, and don't even get me started on energy prices, those were through the roof. Now, I know, Jefferson is optimistic because supply and demand conditions have moved into balance, and wage growth is slowing. Yeah, wage growth, the very thing that actually allows regular people to afford all those sky-high prices we've been seeing. The irony here is quite rich, isn't it? The Fed is essentially patting itself on the back for pumping the brakes on wage growth amid rampant inflation, acting like rising wages were the villain in this narrative all along. Oh, and the mention of long-term inflation expectations remaining anchored? Please. Earlier in 2024, survey-based measures of inflation expectations surged, with consumers and businesses increasingly bracing for a scenario where prices remain high for years. The Fed miraculously managed to bring this back to more manageable levels, but we're far from out of the woods. Let's not even pretend the populace is confident in these projections. Elevated price tags on everyday goods from groceries to home essentials have eroded a ton of goodwill, and that doesn't come back easily. Now, let's talk about those interest rates. After cutting them late last year, the Fed has paused. Rates have settled between 4.25% and 4.5%, a remarkably neutral stance given where the economy's at. But this cautious wait-and-see approach is anything but reassuring, and here's why. On one hand, lower rates have alleviated some pressures. We saw credit card interest rates inch downward, mortgage rates come off their peaks, and businesses getting modest near-term relief on borrowing costs. But on the other hand, this lower rate environment hasn't done much to fix persistent inflationary pressures, nor is it solving slowdown signs evident in industrial production and consumer confidence. This isn't just my opinion either. Let's throw out some cold hard numbers. U.S. consumer confidence fell sharply in the last months of 2024, dipping to around 94.1 in December, which, for context, is well off from the 112.0 we saw way back in late 2023 when people still had some optimism post-pandemic. Today, consumers are feeling anything but confident in this economy. Global industrial production, mirroring similar trends in the U.S., slowed significantly in Q4 2024, falling to just under 1% growth by year-end. Global demand faltered in major sectors like autos and consumer goods. This is clear-cut evidence that the broader picture remains fragile, far from the resilient status that Jefferson claims. Want more proof? Fine. The National Association of Home Builders reported that housing affordability is at its lowest level in decades, with mortgage rates ticking back down since the cuts but still prohibitive for first-time buyers. Meanwhile, personal savings rates are plunging to near-historic lows, sitting around 3.3% by the end of 2024, all while Americans continue racking up debt at a frightening pace just to make ends meet. But hey, why not twiddle our thumbs and wait for more progress on lowering inflation toward that 2% goal, right? Because, apparently, caution is the most likely outcome endorsed by Jefferson and pals. Remind me to be thrilled. And finally, there's the economic elephant in the room that Jefferson conveniently sidestepped in his remarks, President Donald Trump's economic plans. If you were expecting clarity on tariffs or immigration reform, well, better luck next time. The most policy direction we were given was Trump agreeing to delay plans to levy 25% tariffs on Canada and Mexico, a cold war of trade that narrowly avoided another disaster and brought us the gift of tariffs on Chinese goods instead. This move has cascading implications. The US slapped a 10% tariff on Chinese goods, and you'd better believe China retaliated in spades, creating yet another destabilizing force for global trade. For an economy that thrives on globalized supply chains and cross-border commerce, these tariff-triggered pain points are going to reverberate well beyond the usual talking points. Expect prices on imported goods to rise yet again, hurting consumers and businesses alike in 2025. Do we have a clear sense of where these misguided trade policies are headed? Not remotely. Trump delaying the tariffs is like putting a band-aid on a gaping wound. The US-China trade war, compounded by rising geopolitical tensions, is prepping to wreak havoc on global commerce at a time when stability is needed the most. Let's tie all of this together, shall we? This delicate economic balance that Jefferson keeps alluding to isn't delicate by accident. It's been cultivated, if not outright manufactured, by inconsistent monetary policy and untransparent fiscal actions. 1. Interest rate policy. The Fed lowering rates after significant initial hikes tells you all you need to know. They shot first and asked questions later, with no clear exit plan from inflationary pressures. Now, they're unwilling to move, creating more uncertainty than clarity for consumers and businesses. 2. Wage stagnation versus inflation. The suppressing of wage growth as a solution for inflation only stokes the flames of inequality and weakens consumer demand. Reducing inflation is vital, but shackling wage growth while prices remain high. Not a winning combination. 3. Global trade policies. The unresolved trade tensions, particularly with China, have the potential to disrupt global supply chains in continuous cycles. Trump's tariff-heavy trade stance, temporarily delayed but still looming, could result in another harmful wave on prices, employment, and exports. Folks, despite the rosy projections of the Fed, this is an economy walking on a tightrope, without a clear safety net. Jefferson and his colleagues are keen on maintaining status quo interest rates while sidestepping the larger issues of policy clarity, international trade wars, and stagnant wage growth. 2025 is shaping up to be another turbulent year, and that 2% inflation target? That's starting to sound more like wishful thinking. But don't take their word for it. Boss Economics World will be here to keep breaking it down for you, bringing sense to the nonsense that too often circulates in modern economic discourse. Until next time, stay sharp, and maybe reconsider that home mortgage when the Fed is playing hopscotch with interest rates. Let us know in the comments what you think. Is inflation really cooling down? Can we trust the Fed, or are we headed straight into another economic meltdown? And how are you feeling the pinch in your everyday life? Like, share, and subscribe for more insights from your friendly neighborhood economic watchdog.